I do want to bring in Eddie GHABOUR. He's a co-owner at Key Advisors Group. Eddie, it's great to see you this morning. I know one of the last times we spoke this year, you were predicting a pullback at some point in the first quarter. Certainly we've gotten that, the Nasdaq falling 10% below its all-time high. Is there further selling to go, or do you think this is the pullback that the market's needed basically to temper these valuations and things look more optimistic from here?
This is exactly what we were expecting and exactly what the market needed. So now there's a lot of fear in the marketplace. So as a contrarian, we feel like the bottom is in right now in March. In our opinion, the market's going to continue to go up. You know our stance, we've been overweight energy and cyclicals, so we still think that's where you need to be, because the other reason why tech has been selling off is, remember, it's like one of the most highly owned areas that these big hedge funds own. So as they go to rotate into the areas they don't have exposure in, like energy and cyclicals, they're going to have to sell from those stocks. So there could be some continued pressure on some of those NASDAQ companies, but overall, we think it's going to be a rip to the upside, especially in the cyclical and energy names for the next 4 months at least.
So does higher rates, do investors just shrug that off, Eddie? Because I would presume that the yield on the 10-year is going to continue to rise as the economy improves. I think we do have a chart showing just how quickly the yield on the 10-year has risen these past few weeks as COVID cases come down, vaccine rollout ramps up, and of course, as businesses start to reopen a little bit, can investors basically put that aside?
They can. Look, there's this narrative out there right now that rising rates is bad for stocks, and I disagree with that statement based on where we are. I mean, the 10-year is 1.6, okay? Last year, which the economy was terrible, the 10-year was 2.5 in March of last year or February of last year. So right now at 1.6, we think the 10-year could probably hit 1.9. And that just goes to show the rate of acceleration that we're going to see an economic growth in earnings. So rising rates is good because that means we are getting our country back economically. Now, there will be a point in time when interest rates become a headwind for equities, but not at 1.6.
You know, it's interesting, though. I mean, we haven't seen divergence like this in the major indexes in a long time. The Nasdaq now being the notable underperformer the past few weeks, Eddie. So I know you're pretty bullish, obviously, on stocks with the expectations of a lot of pent-up demand on the sidelines and an improving economy. Can the Nasdaq be part of that party, or do you think that the Nasdaq has already booked its high for the year?
So I think the NASDAQ will recover from where their lows are right now. I don't look at the NASDAQ as a leader by any means this year. I think the cyclical plays and the energy are going to continue to have a pretty large delta in regards to their outperformance on NASDAQ. To put it in simple terms, we've told clients coming into this year, what worked last year won't work as well this year. And what didn't work last year will be the leaders this year. Because this year's economy is the complete opposite of the shutdown we lived through last year.
Mm-hmm. We see that the IPO market trying to keep up the momentum here. We're finally going to get the results from Bumble this week, Eddie, after its debut on the Nasdaq just a few weeks ago. Roblox, also another company that we're watching, trying to start trade on Wednesday. And we do see, obviously, reports that Robinhood is looking at an IPO perhaps sometime in the next 30 days as well. As we see the volatility play out in the stock market, are you advising clients to look at some of these IPOs?
We are not. We don't speculate in the IPO space because generally for our client base, they are a little bit more conservative. And when you look at those IPOs, a lot of times you'll see a huge spike initially and then a massive sell-off. So if we were going to get into IPOs, we would wait and let the market settle first because, frankly, we think there's tremendous upside in the cyclicals and energy, and we feel like from a calculated bet perspective, that's a safer play for us.
Mm-hmm. Now, when it comes to energy prices, still on the move this morning, Eddie, it does seem after some pretty strong gains of late, the expectation, as you've outlined here, is that these energy prices can continue to rise. Is there a ceiling that investors should be looking at when it comes to energy prices?
So we've told our clients we had a target of, well, it looks conservative now, 70 to 80 for oil by summer. We think 70 is obviously a given. As we get closer to 80, which I think is very realistic, I think you're going to also see interest rates rise with that. And then that's when we'll start to potentially get a little bit cautious, because then the inflationary headwinds are really going to start to be problematic for the economy. So I can see us, if I had to make a prediction today, that by fourth quarter this year, inflation will be a problem and could hinder growth. And then we would look to maybe de-risk out of the places that we made a lot of money in this year.
Mm-hmm. You know, the jobs market did surprise very much to the upside last month. Of course, we need to see sustained months of very strong jobs growth, 300 plus, if not more jobs, I think, on a monthly basis to really kind of keep this recovery going. Eddie, when you saw that jobs report hit, what was your expectation in terms of what that might mean for pent-up demand and for the strength of this economy?
So I think we're just scratching the surface there. I don't think the market is pricing in the amount of massive pent up demand that we're going to see. This will be the fastest acceleration in growth and consumer spending that we may ever see in our lifetime. There's record amounts of savings right now in the consumer's pocket, and they've been stuck at home for a year. And now with the vaccine coming out, they're going to get an opportunity to try to live their life normally again and travel. So those areas are going to have such massive growth that the employment numbers are, especially in the leisure, entertainment, and restaurant area, it's going to be huge growth over the next 2 quarters.
All right, Eddie GHABOUR, co-owner at Key Advisors Group. Eddie, it's good to see you. Thank you.